All right, folks. Hello, everyone, and welcome back to the PetroNerds podcast. It is Monday, October 16th, 2023. This is episode 99 with Joe DeDominic with Anschutz Exploration. He is my guest today. He is the president of Anschutz Exploration. So, Joe, welcome to the podcast.
Thank you, Trisha. Thanks for inviting me. I'm looking forward to our conversation today. We always have a good conversation between you and I, so this should be lively.
Yeah, no, it'll be lively and very good. And we'll give some a little background on this because Joe is actually my only my second former employer and boss. But we tried to do this podcast on Friday and we had technical difficulties. Fortunately or unfortunately, oil prices actually haven't changed too much, although I did update the timestamp. So I'm going to timestamp this, give a little context on the macro, which I'm sure you're going to want to comment on, Joe, because we talk about this plenty. But right now, WTI as of Monday, October 16th, we're sitting at 87.29. Brent is 90.20. Henry Hub is 314. Copper prices are just about, 358. I still think they are not, they're really telling us a lot about where the macro is. Dutch TTF, that is a real stinger. We have seen Dutch TTF come up significantly. It is at 1665. We'll comment on that in a second, but that is partly because of this Baltic pipeline issue between Finland and Estonia, which had seen some issues, potential sabotage, and it got folks a little nervous, and it has helped push gas prices up. In addition to everything that's going on in Israel, and we're seeing the 10-year yield at it's 4.708%. That 30-year mortgage. If you look on TV, if you're looking on CNBC right now, you're seeing the 30-year mortgage at 7.66%. But if you or I are to go get a mortgage today, that's way north of that. We're looking at 8.5% at if we even get approved at 8.5%. So lots going on there. So last week, you and I spoke earlier in the week, and we were talking about all kinds of stuff on the market. I spoke at the Denver Association for Petroleum Landmen last Thursday, and I do want to comment on that later in the podcast because they had a BLM panel on federal land, and it was very Wyoming focused. So stuff you might want to comment on. But I think before we go much further, there's the elephant in the room, and the important thing to talk about is that this is the first podcast I've done since the war in Israel, and I've been following it really closely. I have dug in as much as I possibly can, and admittedly, I've dug into every Israel podcast I can find that's covering this, and I got to say the atrocities are just absolutely horrific of what happened in Israel. And then the market response has been very, very interesting in terms of how it didn't basically said this was going to compete contained. I think the market response on Friday and today and this week, there's a lot more question marks. Biden is actually thinking of going to visit Israel, and that's because of this contagion impact of whether or not Hamas obviously committed these atrocities, but now Hezbollah could getting involved, and it's I think it's a little more serious than the oil markets probably starting realizing. I thought it was interesting before oil prices were really coming back up to 87. Even now, I don't think the risk premium is kind of baked into oil prices, and usually I'm a little more bearish on that. But I thought that if you want to comment on that, and I know I did find that number. We were talking about this earlier this week, Joe, that OPEC has come out. They kind of reiterated their cuts. Saudi reiterated their cuts along with Russia, but they came out with this 116 million barrel a demand figure for 2045. So that's the macro. We're going to talk tons about the Powder River Basin and Anschutz, what Anschutz exploration is, but however you want to take that, if you want to start talking about Anschutz or if you want to dive into the macro, completely up to you, Joe.
Oh, we can talk about the macro. I mean, I was looking at obviously we'll talk about it some more. Anschutz AEC is mainly an oil producer. We don't produce a lot of gas out of the powder, so we're more focused on oil. And I was looking at the strip and looking at oil prices where they are today versus where they were the last 6 months, and they're roughly they're a little bit higher than average, but it's been a good year for oil. What's interesting to me is natural gas. When I was looking at the spot versus where the spot was 6 months ago, it's up 50% or 48%. But I mean, natural gas has gone up a lot
Yep.
comparison to where it was. So again, doesn't maybe impact AEC as much, but that's an interesting move from the two commodities we deal with.
Yeah, no, I very much agree, and I think people need to be paying attention to it. I think certainly anything north of $3 is a much healthier level than very close to $2 for gas, and I think that has a overwhelmingly healthy sentiment for for all of U.S. shale oil plays and gas plays. But I do think there is a little bit of rise in sympathy. I mean, yes, it's export volumes and everything, but weather. Increasingly, I'm hearing more folks jump on and talk about the concerns about the grid. I talked about this in my talk with the Denver Association for Petroleum Landmen, but we have shoved a lot of wind and solar into our grid, and you're starting to see more commentators and hedge fund folks come on the market and say that they're calling for higher net gas prices because of the spikes that they'll see because of the later in September and October, we had some hotter than expected weather, particularly in Texas, and so the wind that's in the grid, the wind just didn't blow. So that's part of if we continue to see stuff like that, we won't have the draw on. But I really do think that part of this is also, I mean, when you're seeing Dutch TTF at $16 and change, and everybody in Europe was pretty excited that hey, the weather saved Europe last year, they're full of storage and they don't have to worry about anything, and then you have a war breakout in the Middle East and Israel, while they don't produce massive, quantities of nat gas that they're exporting everywhere, there has been an impact to Chevron's facility. They were asked to shut that in. I think they're rerouting some of that gas. And so, I mean, there is an immediate impact because, I mean, the government of Israel asked them to shut it down immediately. And then you just have the knock-on implications. And I think the big one, I don't want to downplay the atrocities in Israel at all because they're absolutely horrific, and my hearts and prayers go out to those folks. But the impact to oil is a big deal because Iran produces well north of 3 million barrels a day right now, and if there are sanctions are the existing sanctions are actually imposed on Iran, or we actually enforce them, we could see Iranian barrels come off the market.
Yeah, no, I think that's interesting. I think that the question to me is, what's the U.S. administration, doing behind the scenes? I mean, I got the feel that they were negotiating with Iran, right? I mean, the hostage for the cash, a deal that they did and various other things. So how does it all play out? There's a lot probably going on. The Saudis um, reportedly have some extra capacity to keep oil in line, even though I know their targets probably a little higher than where oil prices are today. As usual, complex mix of politics and other things going on here. So we'll see where it goes. But yeah, the war does not look good for the people on the ground.
Yeah, and it's hugely complex. And I would say, actually, before this war, and you and I talk a lot, so we talk about this about whether companies should be hedging or not hedging, or where shale is. I really do think that, I mean, this adds a layer of geopolitical risk premium that wasn't there. And we are seeing the Biden administration. Obviously, Blinken went over there. Biden made some very stern comments against telling Iran not to get involved. Very pro-Israeli talk. And then Blinken's been over there. He's now back. He left. He was in Saudi, or he's all over the Middle East. Now he's back in Israel. And clearly there's a lot of issues on, human rights issues within Gaza, all kinds of stuff there. But there's also now in terms of how Israel responds, but there's now questions in terms of the rest of the wider Middle East, because Saudi was, 2 weeks ago, if we were to do this podcast 2 weeks ago, we would have been talking about WTI 84 and the trajectory coming down because all these worries about demand. And that's why a big part of, I think it is very interesting we're not seeing oil prices really ratchet up to 90 immediately, is because there's so much concern about the economy and demand. But the Saudis were thinking, at least there was some thought in the market, not that Friday, but afterward, that the Saudis were thinking if they can get nuclear power if they could help getting nuclear power to actual power generation, not power for bombs, although everybody has to realize in the Middle East, people want nuclear power for lots of different reasons, not just electricity. But they were thinking, hey, the administration is probably thinking, hey, we could ask the Saudis for some more barrels. So it is interesting now that the Saudis are kind of like reiterated that they're not going to do obviously with the war going on, they're not going to do a deal or a rapprochement with Israel right now. That's on pause. And then it looks like obviously this thing is up in the air. So I'm sure that the U.S. is doing a lot of backdoor channeling with all these countries to just stabilize one, relations, because we haven't had very good relationships with these countries, and two, to make sure this doesn't get out of hand. And so we have two aircraft carriers now in the Mediterranean, and I mean that is a pretty strong show force. So that's all up in the air. So that's the background to this podcast on the Powder River Basin with Anschutz Exploration.
Yep. There's one other one that I don't think it gets the attention, and maybe it's not going to happen, but a potential shutdown of the government if the Republicans can't get their act together, that could have an impact too. But I was talking to someone, one of the AEC folks this morning. Their view as well, they always want to settle it because then they make themselves look good. But who knows? At some point, I think the U.S. government's going to get completely jammed up because the sides are so far apart, and that could be a big negative if the government shuts down.
Yeah, no, and I think that's a really good point. So, there is some weight. It's a little tricky when people are like mapping this out and saying, what's the impact on oil and what's the impact on the economy. It is not good in terms of what's going on in Washington. I mean, we don't have a Speaker of the House for the Republicans. Kevin McCarthy said he's not going to run again. And, first time ever in history, he's ousted. He said he's not going to run again, but now he's thinking of running again. They tried to put in another guy that didn't work, and nothing can happen. We can't get additional aid to Israel. We can't get additional aid to Ukraine. I mean, there's some serious issues with the logjam, and that's just just getting war funding. But we do have, when government was extended, as you know, October 1st. And this is largely for listeners' background, but it was extended October 1st. Kevin McCarthy put this deal together. Ukraine funding was not part of that. But then it's an automatic shutdown, basically 45 days later. So that's November 16th, which we're nearing on. And the likelihood of that's high. And so when you see, the treasury yields, part of that is what this is that, the reason the Fed may not have to raise rates is because the yields are doing it for them, right? The treasury yields are up, and that's why that 10-year and that 30-year. We're trying to incentivize people to buy our debt, and we also, this conversation of multiple wars going on, not having we've drained our SPR, our Strategic Petroleum Reserve. That's a real, the Biden administration is completely mute on that. And that is such a serious issue right now, because he drained the piggy bank because he was worried about getting reelected, or his folks getting reelected. And now we have less than 18 days forward cover of demand, and we've got two hot wars going on, and the tension, the implications for spillover are massive. And there's not, and this administration, because they've been so anti-oil and gas, they have not cultivated strong relationships, especially with the Saudis. Not saying, the Saudis, there's all kinds of issues with that. So, but you still have to, I mean, these are just relationships we've had historically in the US, and they're not there. So it's really serious. And the government shutdown is also a big issue because we have, the debt. I mean, we have $2 trillion in debt with the deficit, and we have this massive spending, and we also have $1 trillion. Our interest payments on our debt right now are $1 trillion bucks. So the Washington problem is big. I mean, I'll be going there in a couple weeks, and I'll let you know how bad it is. But it's never fun. It's never good. It's never like you leave there being like, wow, everything's working awesome.
You don't come back. Don't come back with a big positive uplift, huh?
No, and I usually tell them how it is when I'm over there meeting with folks. So it's yeah, I never come back thinking this is amazing. Plus, if I tell people this, but if you want to see the commercial real estate crisis up front and center, it is in Washington D.C. is one of the single best places you can go visit to actually see what is going on, because so many of the office buildings are empty. Half of Georgetown is empty. I mean, it's a really serious story that's a looming kind of crisis on the horizon. But yeah, I know we nerd about on this stuff all the time, Joe and I do. So with that though, do you want to pivot into the powder, or you
Yeah.
can continue? Okay, awesome.
Nope,
So,
that's a great idea, because there's a lot we can talk about the powder, and I know we need to watch the time. We don't want to have people on for 3 hours listening to us
yeah,
talk. So yeah, we should focus on the powder.
so tell us a little bit. So, Anschutz Exploration, and a lot of folks know who Anschutz is. Phil Anschutz, they probably know you as well. But you are a unique company. I worked with you guys. I was a manager for strategy and analytics worked under Joe, and between 2019 and 2020, it is a very unique company. It is very focused on the Powder River Basin. But can you give us a little background and context of Anschutz Exploration and your time there?
Sure, and I'm going to back up just a little bit for folks that may not know Anschutz, or maybe they're outside of Denver. So the company's been around really as an upstream company for close to 45 years. Um, Phil's dad actually had a drilling rig company before they went to the upstream side, and Phil took over the drilling rig company, sold it, and focused on the upstream piece. And really, it's evolved over the years, more production focused, more exploration focused, depending on the time. But overall, it's really been an exploration company for its long history, and a successful one. Found numerous fields, billion barrels of oil across the U.S. and then even some international stuff. And that's been really the focus of the company. until just recently, where we transitioned really to a more well balanced E&P company. So we made the change in really 2015. We focused on the Rockies. We like that area. Folks know us. We have a lot of data. We have people in Denver, of course, that know the Rockies, know the plays, know how to operate. We can, what's the word, fungible. You can move equipment and services around the different basins. So we felt that was to our advantage rather than going and playing in the Permian or something else where the prices are higher, a lot more competition. We're competing against Midland office companies or base companies. So we've done that. We currently operate in 3 states in the Rockies. Wyoming, Powder River Basin is the big play there. We have some operations in the Piceance Basin of Colorado and also in the Uinta Basin of Utah. And we produce in all 3 states, have wells, operate. We have a field office in Vernal, field office in Casper. We're probably going to open a second field office up north as our Powder River Basin expands towards Buffalo or Gillette, somewhere up in there. And we've grown really as a production company, but we still have a lot of exploration projects, which we won't focus on today. They're really kind of off the beaten path and fit with the Anschutz model to put together big plays, a lot of potential, put a big acres position together. We'll take a lot more technical risk and even regulatory risk than a lot of companies, given our private nature and our what we call patient capital. So Phil has a lot of patience, been in the business a long
Patient
time,
capital. I
understands
like
it.
that term. I like that term. That's great.
Yeah, I can't claim I've coined it, but yeah, it works very well for us. We like the model. Myself and I know a number of folks that work here, have been in the public with public companies in the public arena, both as officers of public companies and all the other stuff. Sarbanes Oxley came along. All those issues that you deal with from a public side, we don't have to deal with very many of them. Obviously. So it's a real advantage. We can keep things quiet if we want. We're not real public about what we do. Go about our
No, you're not.
business. We take care of things as needed. We try to be open with companies, one-on-one type of stuff, and we do a lot of trades and work with a lot of companies. But it's got to be a fair trade on both sides. So hopefully that gives some background.
Yeah, no, that was really great. And there's a ton of stuff we can take from there. So, firstly, I do want to thank you for coming on the podcast because I just had Tad True, and so we're having this nice round, good conversations on the Rockies and the Powder. So Tad True with True Companies we were focused on the midstream and the Powder and this Wyoming focus, and we were recording. He was in Casper. But it's really awesome to talk to private companies because you guys don't talk a ton publicly, but you are out there. You speak at Entercom. When I was with you guys, we took tons of meetings. We had a lot of meetings with engineers, a lot of nerd meetings, and talking about the rock, talking about actual completions, and you guys let me do that. But that was also you're able to do stuff as a private company that a lot of public companies aren't. And so while you guys aren't completely public in how you do stuff, you talk pretty frequently at public events and similar to public companies. So you guys are out there and you're speaking you're giving your voice, but obviously you are concentrated in the Powder, and part of that speaking out is talking about the Powder because as we've talked about and as I tell folks, it's very geologically complex. So makes it a super fun play, but there's just a lot to unpack being a Powder River operator and like having this as your core baby.
Well, I think a couple things on that, and you've heard me say it. Geologically complex is a complex statement, maybe. It has some uniqueness to it, but it doesn't also. In other cases, it doesn't. I mean, if
Right.
you really study the geology, and one of the things we did when we restructured back in 2015 is we focused initially from a company standpoint on building out the best geologic staff we could, and it is some of the best geologic staff I've ever had in my career with the people I've worked with. At one point, I think before you joined us, we were actually 50% of the company was geologists. Not
Yeah.
all of them
It
were
was
doing
always a
geology.
geo heavy
You know,
company.
yeah. I mean, so we use that to our advantage to study the place, study the rocks, extend those not just from a basin perspective or an asset basin, but a broader, which we then leverage that learnings to other areas, and allowed us to then, when we operate in an area, we learn something from that. Well, we can transfer that to another area, and that's one of the advantages to the Rockies. Again, given its depositional history of how it evolved when the rocks were laid down, all those type of things, you can use that information. Going to the powder specifically, um, the way I think people should. Well, let me back up. There's a couple parts here. A lot of commentary around the basin. It's complex. It's remote. It's second tier or whatever type of stuff. And it's not just around the geology. It's around the takeaway. It's around the service. It's around, everyone believes the costs are through the roof in the powder. How does anyone even make any money in the powder? You got a bunch of privates and PE backed companies. They don't do anything. They drill a couple wells a year and claim they have the best rock. I mean, all this, it's really kind of cloudy, maybe is the way to say it. And it takes a lot of time and effort to dig into it. Fortunately, we've been focused on it since really 2014. Again, it's that patience piece, and have built our position, and have stubbed our toes a little bit. The story, and I don't know if you recall this, but the very first horizontal well we drilled in the Powder was a Parkman well up in Campbell County. It was the best water well we've ever drilled. Okay, we didn't make
Yeah.
any oil whatsoever.
There's some Shannon wells
Made
like that too.
Yeah, there is. I think it made over 2,000 barrels of water a day. We were trying to figure out, could we use that water for completions, but we ended up plugging the well. So that was our start. Okay, and again, it was the learning, it was the complexity of that
Right.
geology. So the way to think about the geology, if we go back to that question, is what you have in how the rocks were laid down. The way we describe it here, within our shop, is you have the sandstones, right? So you got the Teapot, Sussex, the Parkman, Turner, Frontier, and the Muddy, just as the major ones that produce. Those are those are limited. They are not spread across the entire basin. And then there's areas within those that are higher quality. And if you look, where the old original development of those sandstones was with vertical wells in the 70s, 80s. Those were, even in some areas we're dealing with today. There's some partial depletion from the original wells that were drilled
Right.
vertically, right? And so there's going to be sweet spots. There's going to be areas that look very good, and you just have to know that. And I'll come back to some economics on that if you want to talk about it further. And then the other ones are the resource plays, or the source rocks, and that being the Niobrara, with a couple different benches that pay in there, and then the Maori, which is a little bit earlier because it's deeper and gassier. It hasn't seen the number of wells, but it's definitely picking up the pace of development between us and EUG. And so you're going to, I think, see those much broader spread over bigger areas. We know from our Niobrara results that the distribution between P10 and P90 is fairly tight. Despite our ongoing completions testing and different landing zones and different parts of our acreage. It's not like we're all drilling in one tight area to get tight results. We're doing different things over broader areas. And the results of the Niobrara, and it's all public data, show that the results are actually, and I can't remember off the top of my head, 1.8x from P10 to P90. So it's not like you're getting 10 times difference from the high to the lows. The range is there, and from there you work the cost piece, and we really like the returns in the Powder, and it works for us as a private, in our low cost structure, both capital and operating cost. So we're fortunate to be where we are. We have a nice position. We're largest acreage holder, most active operator in the basin, all those things. And I believe at this point, from the data we've seen, we're the lowest cost operator in the Powder River Basin. So we like our position.
Yeah. So, well, you've said a lot there, which is fantastic. And I want to unpack a couple things. And I do want to get into the geology a little bit more. And I mentioned this on the previous podcast with Tad True. We were talking about that geological complexity, which I don't know if I coined, but I certainly use the phrase a lot in a lot of meetings. You heard me, especially starting out in geo meetings. But the I like the phrase adding needing patient capital to deal with the geological complexity of the powder. And I could write a dissertation, a PhD thesis on how the market does or doesn't understand the powder and why all these complexities actually matter. And that's because it is, I had Harold Hamm on the podcast. I believe you listened to that as well. And he was talking about costs being high and needing to drive those down, etc. But it is really a very, very interesting play to me. And actually, if you just think about this, and you don't have to comment on this directly, but I think it is fascinating to think about, these very, generational wealth, private companies, multi generations of oil and gas. But think about it. Hank True is an upstream guy in the powder. I mean, Tad True's on the midstream, but his father, Hank True, they have upstream in Wyoming, and they've obviously seen through the upturns and the downturns. They've drilled some, that's public as well. You can look at the wells that they've drilled. But I mean, and you've got Phil Anschutz in the powder, and now you've got Harold Hamm, who has bought Samson and then bought Chesapeake's assets, and now has taken the company private. And it's not, Harold Hamm is a geologist, and I believe you're a geologist as well, Joe. So it's interesting, these companies actually being run by geologists, and then they and every geologist loves the powder because it's hard. But it's also fascinating to me that Harold knows the Bakken really well, as you do. And the Bakken, in many respects, is easy. I mean, I love it. I think it's just phenomenal rock. I think it has a lot more to give, but there's a lot of ways to look at the powder in terms of look at these operators, right? You have big private capital, tons of money that are definitely seeing through, longer term lens of like development mode, and that patient capital has a lot to do with that. And then, yeah, I asked Tad about crises and dealing with COVID. And he gave a pretty remarkable story in terms of walking us through that. Obviously, I was with you for part of that, so I know what that was like, and it wasn't very fun. So not fun at all, but it is interesting to see how private companies went through this crisis, and the powder doesn't look the same as it did when I in 2019 and 2020, when I left, because you don't have you know Impact and Kimmeridge and some of these private equity guys are still there, but the love for private equity, and sort of when we talk about private, you guys are private, right? How I talk about it versus private equity, and that's an NGP backed, or name the private equity firm that's backed the companies. And we had so much of that in the big shale boom craziness that did come into the powder pre sort of 2018. You had a lot of private equity that came into the powder. I would say with folks that didn't have a deep understanding of Wyoming, of the old school oil plays, of the Teapot, Turner, and Sussex, all these conventional sandstones, and then thinking about the Nio differently. I mean, people didn't even realize the Turner was a conventional sandstone that sat below the Nio, and you had to drill deeper. I mean, there was all this stuff. So, can you just talk to us a little bit about one, your thought, if you have any thoughts on those three big private, guys with money, and also just kind of the staying powder of the powder, and how it's sort of evolved with the private equity, and now where it's at now. And I know that you obviously have think the cost structure is different, and you can survive in a much lower oil price environment than say what Harold Hamcon in the 80s. But also just talk about sort of where you guys are at, and that I was with you on the COVID side, but if you want to talk about that and sort of how you guys saw that crises and managed through it, it has not been an easy ride, and it's certainly been a wild one.
Yeah, so let's do a couple things or a couple questions there. Let's start with the COVID piece. Again, you were with us. It was extremely, that's what I would call challenging, not that, and complex. But yeah, it was you know, now we look back on it and go, oh yeah, it wasn't that bad, or it was bad, whatever. But at the time, you're in the middle of it. You didn't know how long it was going to last, how deep it was going to run, what it was going to cause for economies. Was it going to wipe out 5 years of the economy, or what, right? And so the reaction and decisions internally were we need to preserve capital. We had several rigs running. At the time, we had three. We went to two, then we went to one, and we stretched it as long as we could. And we're like, what if this lasts 3 years or 4 years or 5 years? And so we actually parked that rig and paid standby on it. We actually parked it in May of 20. We picked it back up in February of 21. So it wasn't even parked. It wasn't even parked a year. And when we started building back up from there, the other thing we did during the pandemic, we made use of that time. Now, I will tell you, production wise, again, being private, we shut in 100% of our operated wells for 8 months. and some of those were brand new Turner wells. I think there was a dozen, if I remember correctly, that we had just brought online in March and April, right when the
I
pandemic was
remember because
hitting.
as we were working on those wells, yes.
It was horrible. It was horrible. Okay. We did, I will say to everyone here, we did see some formation damage. The wells did not come back on as long. We should have produced them longer, even though oil went negative and was $20 and we're pretty much, giving it away. But in the long run, we did some sensitivities, ran some numbers, and we said, okay, we shut them in and we'll get it comes back at 60. We'll get paid at 60. We ran the numbers and it made more sense economically. And we could do that being private. If you're public, you couldn't do that. We had no hedges, so we're unhedged as a company. Always have been generally. So that was the right decision from us in hindsight. The dropping of the rig, like I said, in May, we picked it up in 21, and we built back from there to where we are today with the 5 rigs. We went back and looked and said, well, rather than paying that standby monthly to keep that rig, we would have kept 1 rig or 2 rigs and duck the wells, right? But the cost of those wells, drilling wise, that was the ultimate low point for drilling. We've never drilled wells for lower cost than that, but we drilled enough, going into that period before we stopped. And those wells we brought on in 21 are the highest IRR rate of return wells that we've ever drilled in the basin. They were the lowest cost. They came out as some of the best wells we've ever drilled. They were well located geologically, fortunately, and when we brought them online in early 21 and into later 21, that was the best thing to do as the business ramped up. We took a lot of time. I think we took 6 months, both internally and talking to some various outsiders about where we wanted to go as a company, and we revised our entire company strategy. Again, we were more like a private equity company almost at that point, where we were trying to build enough production and drill enough good wells, and then look for an exit. We said that's not going to happen. The market in the oil and gas industry has changed. People aren't paying multiples on undeveloped and unproven sticks, and we're going to develop it ourselves because we like the return on that investment to drill our own wells and what we receive out of those wells. So we've revised and reworked the entire company, and grown with a focus on the development side. We're currently at 40,000 barrels of oil equivalent a day net, and that's 65% oil roughly right now, and there's some liquids obviously in there too. And we're on a path right now. We're running several frac spreads, multiple rigs, like we talked about. We'll be 50,000 barrels a day equivalent by Q2 next year, and our average for next year, we're still working through the details, but we'll be 50,000 plus next year, and depending on what exit is, what we end up doing for the year. But we've really grown the company because when we came in for the pandemic, we were 10, 12,000 barrels a day in 2020. It's a little bit about the pandemic, a little bit kind of how we went through it.
Yeah, yeah. No,
Um,
that's really good color. Appreciate it.
you know,
So,
so
you give fantastic color. And I think it's obviously different perspectives from different companies of where how you're sitting and how you view it. I mean, with that, you mentioned being more of a private equity thinking and thinking about an exit, and obviously that's evolved. And I think, um, you know, just from your, you don't have to be speaking on behalf of Anschutz, but when you're looking at the powder and the evolution of it, and you've been sitting in it and working in it, and I was with you for part of that, but do you see the evolution where you're obviously not seeing the same level of activity of those private equity backed companies pre-COVID? The same, they have not ramped back up their activity. I mean, it is like you guys are kind of driving, the cart right now, and then you have the companies like you still have Oxy, but you've got Continental, and you got some bigger players in there that are sort of moving, and it's now a more unique space. And it seems to me that that's the and this will help us get into the conversation a little bit about what the powder has and doesn't have in terms of services and takeaway capacity and everything. But how do you see that evolution looking from the small private equity guys going crazy to the bigger guys like you and Continental, and sort of now the staying power with, regardless of price. And people know I'm a little bit critical. I am critical of the industry. I mean, the industry could have done a much better job, particularly upstream during COVID, to not lose their minds like they did, because most folks had a lot more years on myself and a lot of younger folks in the industry that have been through crises before. And to either you lay your head on the pillow at night and you say, I'm producing oil and gas. Am I going to be producing oil and gas 2 years from now? If the answer is yes, then you kind of gotta you gotta like put yourself together and move through it. And I think this industry lost their minds a bit, and we saw how companies capitalized on that, where they drilled through it and they were able to capitalize those very, very low costs, not necessarily in the Powder, but particularly in the Permian Basin, and really run through it. And then we really saw the public's very, very slow to come up with this because of ESG and everything and COVID and craziness. And then it was harder, I think, in places like the Powder, where you had all the Powder issues, and then you have COVID, and it's sort of this morphing through it. But and sorry, that was a bit of a rant, but curious as to how you think that evolution pre-COVID to now, in terms of the private equity guys, folks like yourselves, and now where the play is at and the ability to sort of run this course, regardless of high oil prices.
Yeah, so I kind of break the Powder into maybe three different buckets, if you will, of operators. You got the private equities who, again, were, like you mentioned, very active or fairly active, pre-pandemic, drilling wells across their blocks, trying to prove up different zones and show they had the best Nio well or whatever they're drilling on their block to hopefully then flip it. If you had that group, you have what I kind of call the publics outside of EOG. Devon, Oxy, it was Chesapeake at the time, and then it was Continental for a little bit, and Ballard's another one that kind of fits into this.
Right.
Drilling really more appraisal wells, or maybe small, 1 or 2 DSU developments. They're still doing those things. They're testing. I know we talked to most of these companies. They're still, Devon's doing the 3 mile Nios, trying to prove that up. Continental right now is drilling these multi-formation DSUs. They're doing, Sussex, Frontier, Nio, Mowry, right? And Oxy's doing one we're in, where they're doing Nio, Turner, Mowry, I think is the three that formation. So they're really trying to understand, a way I would say it, delineate and appraise their acreage. And then hopefully they're going to get to a point, or I know they'll get to a point where then they'll say, okay, we really like this area. We're going to put the infrastructure in and develop. We came out of it, and EOG had set the mark, really. If you go back and look at what EOG did, they invested a lot in their infrastructure, actually even during the pandemic,
Yep.
right? They built their corridors, they laid their pipeline, they have water disposal, water sources.
I'm guessing they captured a lot of low costs right there too, with just
They did.
services and everything.
They did, and it was a good year to do it. And so, they were leading the pack. We saw that. We've been, myself and a lot of my team have worked in other basins. We know what mature shale basins look like. We were in the Bakken early. We were in the Eagle Ford early with some of my teams, and so we said we've been through this before. What do we learn? How do we get better? How do we accelerate this? And we put the numbers together, and that's what we did when we came out of the pandemic. Is we said we're gonna develop our assets. We're not going to sit around and wait, hoping for someone to show up to say, yeah, I'll buy your assets. That's not what we are. We want to be proactive. We want to get after it, and we liked our assets. So we started in Converse County, and we did a 20 well cube, Nio and Turner's, right from the start. After we got out at 21, we already laid out, and then we drilled, across that entire, east to west. I think there's 48 wells or something. Don't quote me on that. I have to go back and look at the numbers, but a huge rectangle, essentially 3 different cubes across there. And since then, we've been developing multiple, co-development DSUs or cubes, which are more multiple DSUs, across our southern position, while we delineate our acreage to the north. And we've laid laid infrastructure. We work with the true companies and others to get everything on pipe, not just oil and gas, but we even have water on pipe. At this point, we're 97% on our water in Converse is on pipe and recycled. So it's a real high numbers, and it's a maturity of the asset of our decision to move our assets forward into what we call full development mode. It's not just going around drilling a few pads, trying to figure out how you get water or how you get a pipeline to it. All these companies should know an area that they feel comfortable investing in. I don't know if they're trying to optimize for the last dollar or they're waiting for a better day, but we're real happy with our returns. I mean, some of our stuff in look back, it's $35 break evens. I couldn't have told you that going into it, but given the infrastructure we've put in and the results of the well, I can tell you that's the range we're in on some of our stuff.
Yeah, and I think that's great clarification, and I do think that's why it's so important. You have to be thinking about this by from a geologic standpoint and from a business standpoint, and from the nuances. I think of being these how the play has evolved and developed, and having a lot of tiny P backed entities that had four guys, engineers, and we're going to start an E&P company and we're going to drill two wells. We're going to flip this. So when you have a lot of those, that has been problematic for the Powder's evolution, because that's not staying power, right? That's not like, hey, we have a crisis and we're going to drill through it. That's, oh my gosh, what do we do in a crisis?
Right.
So and the models just weren't that. And so I think a lot of private equity entities, obviously they had to revamp their entire business model of, we're not going to sell this. Do we smash code these guys? What do we do? And I still think that is, we're still not seeing great clarity across the Rockies through a lot of, the private equity guys. And partly that's because I don't think they did their due diligence and really, thinking about how under different risk scenarios, how they invest and move through the business. And you guys, that private capital and that staying power, I think, is really critical in a play like the Powder River Basin, because you have to, the way you're explaining this is really good in terms of, you have to be able to tinker with this play. You have to you're going to have some good wells, you're going to have some bad wells. That's expensive, and you're going to have to, and then you have to develop this stuff out. If you actually want to grow your production base, you're going to have to get comfortable with some of that geologic risk. And then part of it is that, and we saw this, but I ripped through every single Turner well in the Powder, and there's some great Turner wells. There's some really bad Turner wells, and clearly that is there is far more geologic complexity within the Turner than a lot of folks thought in the beginning, thinking it was far more homogeneous, or it was far more similar than dissimilar. And I think obviously drainage, you name it, there's a million different things going on, but a lot of that was spacing matters. I think there was too tight a spacing, and then what's the optimal spacing. But a lot of it was about oil prices and costs. And when you get that cost down to a level, and you have the infrastructure, you get the cost to a reasonable, space versus, and then oil prices are somewhat steady, you get to a space where you can really do this. And new entrants, and Harold Hamm echoed this of, hey, we need $80 oil or something for break even. He's also newer in the play. So as their cost structure gets lowered and they get more comfortable with this, I feel like the ability to sort of take on a little bit of the more risk. And I'm not saying you're drilling a dry hole. I'm just saying, one of those Turner wells is going to underperform the other two in when you do these three wells. And if your costs are low enough, they're still making money. And I think that's where people have to, like, this is that multiple tiered acreage. I'm a big fan of non-tier one acreage, and private companies typically takes time, but do a good job de-risking this. And I think it's the Powder's sometimes harder for folks to look at, because they see that one Turner well in the three that's not good, and what is this? But I think that cost structure and those lowering the costs and being able to bring your break evens down is a huge component of this.
Yeah, no, all those play into it. So a couple things you touched on, I'd like to follow up on. So
Yeah.
cost, obviously, um, I've said it many times to my team. It's the one thing you can control, right? You
Yep.
can control your cost. You control where you spend your money or invest your money. Which means what wells you drill and the timing when you drill them. You can't control oil prices, so the macro piece, yeah, it's kind of nice to know, but you can hedge and maybe do some of those things. But what can you control about what decisions you make day to day, and as a team or as a company, all those decisions add up, right? It's the power of compounding. If you make good decisions, it's even more impactful. So
Right.
we've our ops team has done and our supply chain team done an amazing job on the cost piece. There are plenty of services, and if you run a big program or a sizable program like we are, people want to work for you because they know that we're going to continue. We're not the private equity. We're going to drill 3 or 6 wells, and then we're going to wait a year. Well, no one's going to come up and frack 3 or 6 wells, because then what are they going to do for the other 11 months of the year, right? So get a continuous program, put in the infrastructure. Again, we put in a lot of water infrastructure. We bought some surface lands. We have our own disposal wells. We have our own water wells. We have our own water ponds. We continue to spend, you know, multiples of tens of millions on infrastructure every year. But the return on that, then the payoff on those is at our pace. Okay, you got to develop it, but is a year or so, a year plus or minus. Well, that's a good investment for us, because then it continues to pay dividends and reduce cost down the road, or maybe it has some retained value that we can use with other operators, or sell to someone else down the road. So we look at it as, are we building the value of that asset, increasing the value of the asset that we have put that we have put together and purchased, right? We purchased land, we bought leases, all those things, and we monitor that. We look at that. We look at that with Phil, and are we getting a good return on our investment, and our asset values going up? This goes to the complexity question you had on the geology. So let's talk about the Turner for a second. We drilled from the east to the west, like I told you, across the middle of our block in Commerce County, and really one giant cube, if you will, but we broke it up in a couple different cubes. And we started on the east and had just unbelievable results, some of the best probably in the United States, right? Well, we kept drilling, and anyone can go plot this. This data's out there, and you go from a well that's going to make 2 million plus barrels to the last 2 wells we drilled made only water. Okay,
Yep.
and
Yep.
wow, that looks horrible if someone just came in and looked at it. But if you look at those in total, just put the Turner wells together, what we invested, and again, the Turners, we've optimized the completions. Those are not very big jobs. The rock's pretty good, right? And so, I mean, we were doing those wells for 5.8 million early days, and I think we're 6, 8, or at this point now, and they're small jobs. Those wells make a lot of oil early on, and you put that all together, even though we've lost some capital on those wells that only made water, the whole project was I can't tell you the rate of return, but it's extremely high. Okay, extremely high, and that helps the whole company proceed and do other things. So you're not going to hit 100% of the pitches that come your way, and so you have to look at it statistically. And again, the Niobrara, and I believe the Maori is going to be the same way. The results won't be as broad, but the sandstones, you're going to have a broader outcome. But overall, is your program returning what your investment needs to be, or is it greater than your investment needs to be?
No, that's great answer. And really good color. I think listeners will appreciate that. So it had me thinking, and there's a couple things. I know we're going to be pushing the hour mark, but there's definitely a few things I want to touch on. And that's because when you're articulating this really well, as the staying needing to have that staying power, and because I don't work for an E&P, I can say clearly, the Turner, the evolution of it is fantastic in terms of, I think, how companies approached it, and how public companies approached it, how private, it was like, hey, the teapots are drilled up, the sand, the Parkmans and everything, which were, some of these were just phenomenal wells. You drill the hole, it's 1,000 barrels a day, done. And then those got drilled up, and then so the natural thing was like, hey, and the NIO was where everybody, and this is before I was even with you guys, and I was thinking of starting my own oil company. I mean, the NIO was what everybody is thinking, right? This is the hot, sexy new play. This is the unconventionals. We're going to get a ton out of this. We can downspace the crap out of this. But it was hard. So people were still going, they were like, no, wait, we'll just go after the next easy thing, which should be the Turner, because that's another conventional sandstone. And they didn't understand it as well. And so when they got, folks got into it and they started having mixed well results, but they didn't have those costs down, things got a little lopsided, I think. And you heard this in public earnings calls. There was a lot of, with Chesapeake and Devon who talked about it. And then you can look at the decline rates and you can just look at the well performance. And I think it's that staying power is so important because I've been talking to lots of folks on the podcast and lots of folks in the industry and lots of folks through work and business and PetroNerds in my business on ESG and the investor pressure and the ability to access capital. And you have to be able to have that staying power you have to drill a few wells. A few wells can be 30 million bucks. It's a lot of money. And so you have to be able to drill that and get those results to understand it. And the reason I point out the Turner is because I think a lot of folks in the beginning did think, okay, big completion, put a big completion on it. And no, if you're getting mixed results and, geology has a lot to do with it in terms of understanding it. But if you're getting mixed results, maybe too much water, and that mixed results in and of itself is, reduce the completion costs, reduce the size of this maybe, and get to a space in which the cost makes sense and the returns make sense. And so that's, sometimes I think from a geologic and completion standpoint, that's hard for teams to do of thinking, oh, we can get the most out of this. But then you start factoring spacing and drainage and all these things. And the Turner's one of those that's like, no, it makes a lot of sense to actually minimize those costs, try to get that repeatability and move forward. And that's also, that piece went out in COVID. No one was articulating that. So it missed sort of the market period. But if you can imagine pre-COVID, a company going on to the public market and being like, yeah, this formation is okay. We just have to reduce the completion costs. And we're just not going to talk about this very much because no one's going to care about it too much, but the returns are going to be great. Like nobody did that. And actually it's probably where public companies need to get back now. And I know EOG is not drilling as many Turners and they're drilling more Nios and Maoris. And you don't hear public companies talking nearly as much about the rock. But it is why in the beginning, folks were investing in these companies because they were talking about what we have to offer. And I just think the Powder is kind of a really interesting case and microcosm of that story of how you go through this and how you have to have this staying power and you think through these problems and you get to a place on the other side to where the money makes sense and you're getting the returns. But if the private equity money, which is threatened by ESG and the whole anti oil and gas movement, there's some risks to that. Obviously, you guys are kind of outside of that, but you may want to comment on any of that I just said, but I really do want to ask you about the world of access to capital and ESG, and you guys aren't in that world, but how you're seeing that and how you're thinking about it, how critical and important it is to the evolution of the privates and the evolution of acquisition environment and the next phase of oil plays. I mean, you and I talk about it offline, but I think it'd be great for listeners to hear your thoughts on that.
Yeah, well, we're focused on it. I'm probably not to the extent. Well, I know not to the extent that the publics are, or maybe some of the private equity. It's obviously we all know this, right? Everyone's listening to this. It's a real thing, right? The governments are putting new regulations in hourly, I think. Not daily, hourly. That we have to stay on top of. We have to follow. We want to follow, right? And so yeah, we're actually have stood up an ESG group. We just hired an air quality specialist who's going to join us shortly to handle with all the the emission monitoring, and we've had a lot of conversations around do we go to continuous monitoring? We're actually having a flyover of our assets forthcoming soon, and I mean so we are addressing and staying on top of all those things as the market and the business and the regulations and the governments, and the politicians and all the environmentalists, direct things. We want to stay on top of that. If we look at potentially some option in the future. Let's say there's a company we want to merge with, or someone wants to buy us out for some reason that makes sense for us. Then if we have a very clean ESG status, then it's favorable. I mean, you saw Chevron's PDC acquisition. One of their footnotes or one of their bullet points was, well, this is going to make them cleaner. I don't know how they phrased it, right? But essentially, PDC had a very good ESG record and how they monitor their stuff, being in Colorado and everything else. Like I said, we operate in Colorado. We'll probably take some of those because of their regulations as a state are even greater than some of the Fed pieces, we'll take those learnings and those operations to our other assets. I think that's a big piece that we all have to be aware of and incorporate. Does it impact us? Fortunately, no. From a capital standpoint, we are watching the insurance piece very closely.
You brought
We're
that up. I
actually
was going to just ask about that.
okay. We're watching that very closely. We actually, I think I can speak to this. Last week, we had our meeting with our insurance broker. We're getting ready, to go out for our renewal and all that stuff. And their commentary was, well, there's actually, the last couple of years, a number of long-term companies backed out, right, of insuring oil and gas. Well, they told us there's actually some new ones moving into the space to fill in that hole. I always have said, well, capital, if an opportunity to make money, people tend to direct capital where they can make money if it makes sense for them. And so there might be some, and I don't know this firsthand. I've heard this from someone else who's working for us, but there's some coming into the industry and for the insurance piece. We'll find out. We're going to go for our renewal and really test the market this year from the insurance piece, given our growth and given we have a lot of infrastructure, we have a lot more wells and production than we have historically. So we're growing as a company, so we need more coverage and a bigger insurance piece to take care of that. So those pieces.
Yeah, no, and I think that's huge. It's something I can't, underscore enough for listeners and for folks in this business is to really be paying attention to the insurance piece because we've seen
Yeah.
a lot of folks come out of that. And I remember just being a kid and and then going to London and I'm seeing Lloyd's of London and my dad telling me when I was little that Lloyd's of London was the only, and this is back in the day, and I'm third generation oil and gas, and Lloyd's of London was the only entity that would insure, hot oil trucks to pick up this oil from these wells. And I mean, so this has always been a thing, but I think people have to really, really pay attention when you have these ESG pressures and these regulatory pressures and access to capital, the insurance piece, just to do your day-to-day business. I can tell you as a service company with the name PetroNerds, certain entities and contractors require I have insurance and it's hard to get it. It's very hard to get depending on those whatever the requirements. It's actually hard to get because I have a company called PetroNerds, which that's I'm not in the field hacking away at drilling wells, but they still don't want insurance, so it's a reality. So that you cover that, and there's two last things I want to close on. And if we go over that's a little bit over that, that's okay because I think it's really important for listeners. And you clearly are a wealth of knowledge, but so I know you wanted to talk about where the state of the what's the good stuff about the powder and the things that service costs I think are really important to think about. You and I have both talked about takeaway capacity. We have ample takeaway capacity. I talked about that with Tad True. I do want to comment before we close and talking about the Dakota Access Pipeline. I think that's an important thing to address. But what about service costs? And the one thing people always talk about in the powder in the Rockies is as we evolve through the business, sometimes when things get thin in the Rockies, we can't get the services we need. And it's not that I saw that when I was working for you guys, but it is a reality in terms of, do you have the staying power of are the service companies there? Can you get a Liberty frac fleet or Halliburton frac fleet, or at the time it was Schlumberger, but now that's Liberty? Could you get a frac fleet on demand? Could you get and yeah, maybe a frac fleet, but what about all the other services you need? And there's as plays are evolving and they're doing stuff, that's one thing, but also as everything goes to the Permian, and then you have the Bakken is a seasonal play now, and so you've got kind of the powder that's not seasonal. You got the DJ that's just crushed by the regulatory, so it's on and off all the time, and Chevron vice PDC, and then it gets thin. So I'm just wondering if you can talk a little bit about water has always been a cost issue in the powder, service costs and components to that of how you guys have sort of seen through it, where it's at, and what it looks like, and maybe we can close on the takeaway and the Dakota Access question.
Sure. So I would say, back up a little bit again. We talked about the company's history in the powder. Early days when we were drilling 6 wells or 8 wells, maybe had a half a rig or one rig. Getting services were not super easy. Now it was a little busier in the powder then, and I think that goes for most of the United States if you look at the rig count.
Right.
And so if you have a continuous program, if you can say, yeah, I have my capital budget's approved, I'm going to drill this many wells. I want you to come up here and do this work for us. We've had great success in having operators fulfill our needs, and we've been able to high grade and find better performers, better companies, better services, companies that are bringing new ideas to the basin, because they're looking to expand outside the, I call it the uber competitive Permian, right? I mean, there, if you go down there and you're a frac company, I guess, how many other frac companies are in the Permian right now, right? You go to the Powder, and yeah, there's at least three or four that we use, and there's some big names in there. I won't name names, but we've been getting some very good performance, and this goes back to, it's not just us on this continuous operations piece, but all the service companies. If the industry can kind of keep going at a more, and we call it level loaded pace, the people working on the spreads, people working on the rigs, people driving the trucks, are much better, right, than a bunch of green hats and people that are new, and you're transferring people around, and we're not going
Right.
way up and way down activity levels. So if we can stay at a right pace for the industry and as operators, that's beneficial. The water piece and all the other components, water, there are some very high cost agreements out there in the Powder. Some of the, again, the Powder's not new to oil and gas. It's gone through, this is the third phase of development in the Powder, right? And so some of the landowners, some of the people that own the minerals are very wise. They're not, they've been through this before. And so the contracts are very, very expensive and very hard on operators. We've tried to be creative. There's ways you can do things um, that work. The other thing is that in Wyoming, compared to say the Permian or even Louisiana, it's a split estate. So the surface owners don't own the minerals. So if you think about it, when we were operating the Eagleford, you know, they own this. The mineral owners own the surface as well. So they they would look at it and say, okay, if I can get oil out of the ground or gas out of the ground, I'm going to make more money. I can take a little bit of a hit or less money for my water or my surface use, right? Where in the Powder, the people with the ranches and the surface owners, they don't get anything from the subsurface,
Right.
and so they want to make their money on there. So you have to think about where they stand when you negotiate your deals. And you got to get ahead of it. Everything in the Powder, I'll say this right now, is you have to be looking out years ahead. You can't, and it almost goes to the patience piece. You can't come in, buy some acreage, say, I'm going to go get a rig, I'm going to drill tomorrow, and then I'm going to be producing 3 days later. Or, I'm being kind of, half
Right.
serious here, but it's not going to happen. I mean, you got to get permits from the feds, you get surface use, you do have some winter issues. It's not North Dakota by any measure, but you still have some winter issues.
It is Wyoming.
Um,
Yep.
yeah, right. It is Wyoming, and the wind blows a lot too.
It does.
uh, and so all those, you have to take all those things into consideration. But that doesn't mean it's not a good place to be. I mean, it is, and there's not. We don't deal with town lots or
Right.
too many houses, and it's really rural. People understand how to work hard, what oil and gas or coal or whatever it is, what energy means to the United States, and the security. I mean, we're I have a photo, and I should put it up sometime. Maybe we should put it on our website. You can see our drilling rig. You can see some of the turbines from electrical power that they have out there. And then if you kind of look off in the distance, you can see a rail car hauling coal out of the basin. I mean, there's like three different types of energy, right? All within like a stone's throw of each other. And so it's a good place to work overall, and good people to work with up there and everything else.
Yeah, no, that's great clarity, and I think, that, and Todd mentioned this too, and this something. And if you know Wyoming, I mean, it is a great, it's a great place because people do know oil and gas. And the Powder River Basin, just for context for people, I mean, it's home to the this is some of the largest surface coal mines in the entire world, in Wyoming. So Wyoming is not new to this. And I mean, my grandfather and my dad chased every oil boom in the Rockies, and a lot of those were in Wyoming, and coal bed methane and Gillette. So I mean, where you have resources, you have resources, and Wyoming obviously has the resource. It has the coal and the gas and the oil. That sophistication of the landowners, I think, is always very interesting because that water piece of it's water hauling. It's also that some of these wells produce a lot of water, and I mean, there's just you have to get those pieces. But I think it sounds like you guys have a lot of folks have gotten the disposal cost for water buttoned up to a level that is better than it was several years ago.
But let me build on this a little bit. Again, it goes back to if you're only drilling a couple wells or a small
Right.
number, you haven't you don't have the capital maybe to make the investment, the infrastructure piece. You haven't thought through it maybe holistically and over time, and you're having to haul water and dispose of it in some of the bigger disposal sites. It's gonna cost you. It's not cheap, right? But again, if you look at it and say, okay, how do I best how do I invest my money to get my best return? Well, I should put some money into infrastructure. I should buy some land or do a deal where I can drill disposal, I can store water. Again, where we're using a very, very high percentage of our produced water, well, that's a double savings, right? You're not having to haul it or pump it into the ground. You're actually using it to frack your wells. So it becomes a positive rather than a negative. But it takes time. It takes time to put all that together.
Right.
It takes money. It takes patience. It takes a lot of hard work to get there, and our team has done that. So I think we're in a good spot. I think you were talking about Harold and some of that stuff. Looking over the fence because Continental is just west of us. What they're doing. They're doing a lot of things that we did early on. We did some appraisals. We didn't do as much appraisal as a lot of companies. We kind of again take that technical risk, and we went into early development mode without a lot of well control, and it worked for us. I think other companies want to get more now. Keep in mind, Continental, Oxy, Devon, EUG. We'll pick on those. They have, this. Everyone knows this. They have assets all around, right?
Yep.
And maybe their assets in these other basins are in full development mode. They have infrastructure. Their margins are higher. In the Powder, they haven't made that investment. They're not as far as along. And so, where would you go? Well, you're going to limit how much capital you have up here until you're ready, or you start to run out of locations somewhere else, and then you'll move your capital
Right.
to
And
the
you're
Powder.
public, so you got to fight for those. Each basin has to fight for those dollars.
Correct. Everything has to be perfect, or
Right.
you the highest maximum point. So, or we could start because this was our key Rockies position. We have some other stuff that's less mature right now, and I'll tell you that's exactly what we're doing. We're not putting very much capital into some of our other projects in other states because most of our resources are going into the Powder River Basin today. But I think you'll see us over the next 3, 4, 5, 6 years growing in other areas as well, and we'll have a multi-basin, larger multi-basin oil and gas company as we continue to grow.
Yeah.
So,
No, that's great. So, I know we're over time, but there's two questions I need to ask. And that's that. So I do want to ask about. So we know that the basin has takeaway capacity, right? From an oil standpoint, and that's because we have, from through the Rockies, from Wyoming, from North Dakota through Wyoming, and then to Cushing and down. The takeaway capacity for oil and for gas, although I mean that's a little bit trickier, but we have a little bit less gas in some areas, as you mentioned. But we have enough takeaway capacity right now for oil and gas, ample capacity on the oil side. But there is, and this is kind of twofold in two separate questions, but Wyoming, and I love Wyoming. Born there. We're both recording from Denver right now, but I'm a total Wyomingite, and really do need to get back closer to home. However, that being said, Wyoming has a lot of Bureau of Land Management land, has a lot of federal land. And when I was at this conference last week with the Denver Association of Petroleum Landmen, there was a BLM panel, and it talked heavily about, there was a guy from the BLM there, and they talked heavily about, Wyoming. This was very Wyoming focused, and everybody, all these landmen were focused on this. And it was very disheartening to hear most of the panelists try to qualify how great the Inflation Reduction Act, which is not an Inflation Reduction Act, but how great this IRA Act was, and they talked a lot about the impacts of the Inflation Reduction Act on BLM land, particularly in Wyoming. And one was the increased royalties that it, to bring up federal land, just immediately increased royalties, but then a lot of complexities in terms of actual greenhouse gas emissions and permitting and everything. And we already know from the beginning of this administration, banning permits on federal lands for 2 months. And then, that went away, and they did it with tribal lands, and that was illegal. But then, canceling Keystone XL, and then the lease sale pausing. And I asked this panel, is the administration legally compliant within their lease sales? And I did not get a clear answer. We know they are not. But I'm curious as to how you guys think about that. I mean, permitting is one thing, but the state of play in Wyoming, from just the BLM side and the federal land side, it is a weight that Wyoming has, despite how pro oil and gas, and being the cowboy state that it is.
No, that's the way I would phrase it is that's the biggest overhang on Wyoming or actually the Western United States. I mean, I have one during when Biden first got into office. You pull a map that shows federal lands across the United States. It's massive. I
Yep.
mean, Nevada I think is the worst, but we're not drilling oil and gas wells in Nevada. But Wyoming's like number 2 or 3. I think Utah's fairly high as well. But the federal government controls a massive portion of all those states, and it has a massive impact on them, right? I mean, the bonding rate they're proposing is going to go up. The royalty rate is going to go up some. You now have to pay for any tract you want to nominate to actually potentially come out in a lease sale. You have to pay a nomination fee. They've changed the rental cost. All of it's not massively material to the economics, but it does cost more. It does spread out the time. Again, I go back to the patience piece. Maybe that's our key word from this
Yep.
podcast is patience. Is with the federal government, you have to have a lot of patience. They've been really slow having lease sales. They've had a few this year. The environmentalists sue, everything, right? I mean, at some point they're going to sue us for driving the car, to go to the grocery store. They'll probably sue us, but you know, um, it just takes time, and you have to have optionality built into your program because if something gets hung up here because the BLM won't approve a pipeline, then you need to be able to go there. We're fortunate. Again, we built a very large position. We have about 450,000 net acres in the Powder. We have 4 different development areas and appraisal areas. So you got to have you got to have that built. Again, if you don't have the size or the capital or ability to build something bigger, I think you're gonna be really challenged in the Rockies, given the overhang of the federal government.
Great point and good clarification. And I know we're way over time, but the last question, and we'll close, is: are you hearing folks talk about Dakota Access? And I'm increasingly talking about this more with guests and in business. But Dakota Access Pipeline now is open for the environmental impact statement is open for review. And Tad had a pretty clear answer of, hey, I just don't think the federal, the Biden administration is not going to want to shut down this pipeline even for a short time period because that would impact 600 to 700,000 barrels a day of crude that could get shut in overnight. Gas prices go through the roof. But I don't have a lot of trust in this administration on oil and gas, even understanding it. So, I do question a little bit. And I'm just curious, are you guys thinking about like the environmental impact statement, the EIS is open for review of an existing pipeline flow and crude, and Dakota Access was already fraught with, all kinds of issues before it got up and running. Now it's up and running. It's flowing, half a million, over half a million barrels a day crude going through Illinois and down to the Gulf Coast, bypassing Cushing. Are you guys thinking about that? And is that, are you hearing folks talk about that? Or is this just something we'll wait when it happens?
No, we follow it high level. I'm not in the weeds on it, but we do follow it, and I'll tell you why. For periods, when crude export out of the Bakken becomes blocked or challenged, some of it ends up coming down, and Tad may know this better. Tad probably knows this better than I do. Comes down through
Right.
Wyoming and then cuts over through Colorado over to
Right.
Cushing. That does impact in the Powder. It does impact our nets, to the wellhead because those start to get much wider than they have been. Generally, we're either $2 positive to $2 negative in the Powder. We're really close to WTI.
Right.
But when crude from the Bakken comes down, at one point we were $10 negative.
Yep.
Similar to things you could see in the Permian, right? If things get backed up and everything
Yep.
else, it's one of those things that we're aware of. We're somewhat limited in what we can do. To be honest, I mean, if it gets shut down or something were to blow up or whatever else happened, we're gonna suffer for a while until things get back to normal.
Yeah, well, that's great clarity, and I think the answer to that, and you and I have talked about this a lot, is education is pretty critical and getting people to understand these issues. So, forums like this, people talking, I think is a big deal because I think a lot of people just aren't aware of that. But
Yep.
it's been an absolute pleasure, Joe, having you on the podcast. Really, really appreciate your time. Thank you guys for listening. But thank you so much, and we'll definitely have you back.
Yeah, no, thank you. Enjoyed it. There's probably like another hour we could talk about, but it was very good to cover all these subjects. Hopefully it helps you and everyone else. I appreciate again you invite me to be on, and always enjoy talking to you.
Yeah, absolutely. Thank you. Bye, guys.
Okay, thank you. Yep, have a good day.